Growth in construction is accelerating, and a disciplined credit strategy has never mattered more. Welcome to the Commercial Pulse update for February the 24th, 2026. The Experian Commercial Pulse report is a bi-weekly snapshot of the US economy and its impact on small businesses. January unemployment came in at 4.3%, down slightly from 4.4% in December and marking the second consecutive monthly decrease. At the same time, the US economy added 130,000 jobs, the strongest gain since December of 2024. Wage growth also continued, with average hourly earnings rising to $31.95. On inflation, we saw continued easing. January inflation slowed to 2.4%, the lowest level since May of 2025, with core inflation also edging down lower to 2.5%. For credit leaders, this suggests moderating cost pressures, but not a full return to pre-tightening conditions. Small business optimism registered 99.3 in January, slightly below December's reading. Meanwhile, consumer sentiment rose to 57.3 in early February, reaching its highest level since August 2025. From a lending perspective, there's a key dynamic to watch. While the Federal Reserve held rates steady following 3 quarter-point cuts in late 2025, commercial lenders continue to report tightening standards, particularly for small firms. And that tightening posture is showing up in credit performance indicators. The December Experian Small Business Index decreased 6.2 points to 45.8, down from 52.0 the prior month, though still up 5.3 points year over year. The index remains within the normal range of 40 to 60, but the monthly decline coincided with higher delinquency rates, rising balances, a reduction in new credit activity, and this signals a tighter lending environment and growing risk sensitivity across portfolios. And we'll report on the January Small Business Index in our next update. This week we turn our attention to the US construction industry, which contributes 4.8% of total US GDP, and it's forecasted to grow. Since 2013, the number of construction firms has grown by 28%, reaching nearly 950,000 establishments. Employment has grown 49% since 2010, and construction spending peaked at over $2.2 trillion in 2024. It contracted 3.3% in 2025, but it's forecasted to grow 7% in 2026 to over $2.1 trillion. Non-residential construction remains a key growth driver, supported by AI-powered data centers, renewable energy projects, and infrastructure modernization. However, the credit environment in construction is tightening. According to a 2025 BILT study cited in the report, 70% of contractors regularly face delayed payments, and 41% increase their use of credit to manage cash flow. Top contributors to payment delays include technology and process friction, banking delays, administrative inefficiencies, contract disputes, and cash flow constraints. From a portfolio standpoint, construction businesses seek credit more than twice as often as businesses in other industries and maintain more commercial trades on average. They also exhibit higher 60-plus day delinquency rates relative to other industries. For chief risk officers, that combination, higher credit demand, tighter standards, and sector-specific payment friction, creates both risk and opportunity. To address this, Experian developed a purpose-built risk model for the construction sector. It uses advanced machine learning methodology, predicts the likelihood of a business becoming 61-plus days beyond terms within 12 months, incorporates aggregate business data, public records, trade data, and construction-specific attributes, and produces scores ranging from 300 to 850, where higher scores indicate lower risk. Performance comparisons in the score show stronger KS and Gini metrics versus generic all-industry scores, as well as improved bad capture rates in lower scoring deciles. The key takeaway? Developing industry-specific models allows for better KS separation and more precise credit decisioning. For lenders allocating capital in tightening markets, precision matters. Risk strategy at the trade level can materially improve portfolio outcomes, especially in sectors experiencing payment volatility. And there's a lot more on the growing construction industry in this week's report, so be sure to subscribe. If you found this update valuable, explore more at our Commercial Insights Hub, and of course, subscribe to our YouTube channel. And if today's insights sparked ideas about how insights on small business like this can drive your business forward, reach out to your Experian account team. Last, keep informed to stay ahead, and we'll catch you on the next one.